Hi guys, in this video we will be doing the chapter number 6 of ACCA F3 Financial Accounting, and the chapter's name is Inventory. Before watching this, make sure that you watch the previous videos. If not, you can check it in the description box below. Okay, so before we start with this chapter, make sure that you have a notebook with you, a pen with you, and a calculator with you. And I want you to write everything I'm teaching, or you must be solving the questions with me while I am solving. You need to solve it in your notebooks. If you won't do this stuff, then you won't be able to understand anything. So make sure that you have them ready. And in the following videos, I will also be solving the Kaplan exam kit. So make sure that you watch that also. I will link everything in the description. So in this chapter, we will be studying about inventory, and I will try to complete it in one part. If not, it will be a two-part video. So inventory is nothing but stock that a business has. So what is stock? If I have a business of shoes, then shoes is my stock, or shoes is my inventory. If I have a business of books, then books are my stock, or books are my inventory. So that is what inventory is. So in this chapter, you will keep this in mind that we will be following the international accounting standards too. So whenever it comes to inventory, you need to keep in mind that IAS 2 is being followed. So okay, so first thing we'll be studying is how inventory is recorded in the financial statements. So and after that we will be doing some of the formulas. Okay, so before we read this theory here, let me first explain and introduce you to some formulas. After doing that, we will come back to this theory. It will be easier for you, and don't worry, it is very easy. You just need to write these formulas down and learn them with me, then you'll be good to go. It's not a difficult chapter at all. You just need a lot of practice, and you need to learn the formulas. Otherwise, this is a very easy chapter. Okay, so first thing you need to keep in mind is that revenue is equal to sales. So whatever revenue you earn, it is equal to sales. Is there any confusion in this? The amount or the income which is generated from sales is the revenue. So this is the first formula which you need to keep in your mind. Before that, let's also discuss some of the topics. You know what opening stock is. What is opening stock? Opening stock is nothing but opening inventory. Opening stock is also equal to opening inventory. You know that. Inventory and stock are one and the same thing, so there's no confusion in this, right? And you know what closing stock also is. So closing stock is also nothing but closing inventory. I hope there's no confusion in that as well. Clear till now? So you need to know what purchase is. So you know what purchases are. So now tell me, what are net purchases? What are net purchases? We have done this also. So net purchases are nothing but purchases minus purchase return. When you subtract purchase return from purchases, you get net purchases. And you know what net sales are, sales minus sales return, but we're not getting into that right now. So easy. So far you understood everything. It's not difficult at all. This is some basic stuff. Now let's see what cost of sales is. So this is the important formula. It's very easy. So cost of sales. So what is cost of sales? So cost of sales is also nothing but cost of goods sold. So these so these are just another words for the same. Revenue is also known as sales. Opening stock is also known as opening inventory. Closing stock, closing inventory. Net purchases is a formula, and cost of sales is also known as cost of goods sold. So this is some basic stuff which you need to be clear with before we do the formulas. So there's no doubt till now. Now let's see what is the formula of cost of sales. I hope you're writing it down. You just need to learn this formula. By using this formula, we will be doing all the questions. So you know what cost of sales really is, right? First you have revenue. Revenue is nothing but sales. And then in revenue, just a second. Okay, first let's do the formula of cost of sales, then we'll do of the gross profit. So what is cost of sales? First we have opening inventory, right? You know what opening inventory is. Opening inventory, what after opening inventory? You add purchases, you add net purchases. After net purchases, you subtract the closing inventory. Clear? You subtract the closing inventory. After that, what do? That's it. So what is the formula of cost of sales or cost of goods sold? Opening inventory, you add net purchases in it and you subtract closing inventory. Learn this formula well. So you have opening goods with you, you add your purchases in that, and then you subtract the closing inventory, then you will get the cost of sales. What is cost of sales? That is the amount which you had spent in making the goods which have been sold. Easy. This is a formula you need to keep in mind. Cost of sales. What is cost of sales? Opening inventory plus net purchases minus closing inventory. So write this formula 3 times and learn it. Now think about it logically. What will be the profit? What will be the gross profit? How will you calculate profit? This is something very logical. So whatever revenue you have, from the revenue, if you subtract the cost of sales, you get the gross profit. Isn't this logical? From the revenue, from my income, if I subtract the cost which has been, the money which has been used up for making the goods sell, that will be my gross profit. So from my revenue, if I subtract the cost of sales, I get my gross profit. I don't think there's any confusion in that. Very basic, logical. Okay, so that's it. These are the formulas for now. So only these formulas, you need to have them in your mind, and we will be solving all the questions. So let's just quickly revise our formulas. So revenue is sales, no confusion. Opening stock is also known as opening inventory. Closing stock is also known as closing inventory. And what are net purchases? Purchases minus purchase return. Cost of sales are also known as cost of goods sold. And what is the formula of cost of sales? Opening stock plus net purchases minus closing stock. And what is gross profit? Gross profit is nothing but revenue minus cost of sales. Right? I hope that is clear. Now if you move on, this is the table which they have made. I have explained the same thing in an easier manner. So what they have done is exactly the same thing. So this is the formula of cost of sales. They have written it in a very confusing format. If this suits better for you, you can see that. But what I've taught you is the same thing. I've just written it in a horizontal format. They have written it in a vertical format. Okay, now let's quickly read the theory what has been written here. I will read it out for you. If you have any doubts, then you can drop it in the comments below. I am not explaining this because we have just done this. Many business entities only record inventory in the ledger account at the end of the accounting period. So you know what ledger accounts are. Ledger accounts are the T-shaped accounts. During the year, the relevant sales and purchases are recorded, but the increase and decrease in the assets are ignored. Using this approach, the movement in inventory is considered only on an annual basis. In this way, a business can calculate exactly how much inventory it has used in the year to calculate the cost of sales. This is often referred to as periodic inventory records and will normally coincide with the annual inventory count and valuation performed at the end of an accounting period. Right now, you might not be understanding what this periodic inventory record is. We will be doing all this in the following chapter. When we go to the next topics, we will be doing all this, and all this will be easy for you. So we calculate the inventory on a periodic basis, on an annual basis. So that is something you need to keep in your mind. Okay. However, note that some business entities maintain a system of continuous inventory counts. So some people have a periodic inventory count, some people have a continuous inventory count. So what is periodic and what is continuous, we will be doing that as we move on further with the chapter. I'm not explaining it right now because you will get confused, so don't worry about that, we will come to that. Okay, the practical application of how a continuous inventory, we will go to that as well. So this is what is important, this formula, we have seen this formula clearly, done with that. Now let's go forward. Consider a business entity that has some items of inventory left over from the previous year. So when inventory is left over from the previous year, what is that called? It is the opening stock. What is the opening stock or opening inventory? Opening inventory is last year's leftover stock, right? It then adds to this by purchasing more inventories for the year ahead. It then uses this pool of inventory to manufacture its products, which it will sell to generate sales revenue. At the end of the year, there is likely to be some inventory left over to sustain the business in the future. And the stock or the inventory which is left during the end of the year, that is our closing inventory. We have done this, there's no confusion, I hope. When calculating gross profit, we match the revenue generated from the sales with the costs of manufacturing the goods. This also we have done, right? You know what the formula of gross profit really is. Okay, that's it. Now let's move on. So, the accounting principles which are used in this chapter: the carrying forward of unused inventories, the application of the matching concept. We have done this in business and technology exam, if you can recall. So, this is the matching principle, which is the accrual concept. You know what matching principle is, you know what accrual concept is. You just have to keep these in mind. You know it because you've done it in the first paper. Okay. Let us do the question now. It will be very easy. You know the formula now. Just don't see their solution, do it by yourself. You will get the answer. At the beginning of the financial year, a business has $1,500 of inventory left over from the preceding accounting period. What does that mean? Preceding accounting period, you have left over, which is opening inventory. So write that down. Opening inventory. You have opening inventory. How much? $1,500. Okay. Okay, what does the question say? During the year, it purchases additional goods costing $21,000. So you know what the purchases are. Purchases are also given, which is nothing but $21,000. Okay. And make sales totaling to $25,000. You know what sales or revenue is. We know sales is equal to revenue. It's given in the question, which is 25,000. At the end of the year, there are 3,000 goods left that have not been sold. So what is that? Left closing inventory. So we have closing inventory, which is how much? 3,000. Now how will you solve this? You have everything with you. You have literally everything with you. You literally just need to find the cost of sales using this formula. This is given in the question, purchases is given in the question, closing inventory is given in the question. And you know how to take the gross profit, revenue minus cost of sale, everything is given. This is a direct question. So I think you can do it by yourself, and you can check, pause the video right now and do it and check the answer. Answer will be 5,500. So sales opening, this is our cost of sales. From the sales we are subtracting the cost of sales and we get the gross profit. That's it, very easy. Now let's go to the test your understanding 1. So Peter buys and sells washing machine. He has been trading for many years. On 1st January his opening inventory is 30. Okay, let us write this down. Test your understanding 1. Let's do it. I'll do it for you. I hope you are also doing this. So we're doing the test your understanding 1. So what is the question again? Peter. We had Peter in the question. So firstly, let us just write down what is given in the question. Peter. So what are the things which we will get to know? Opening inventory. Okay. Closing inventory. and we need to know sales or revenue. It's the same thing, and we need to know the purchases. Right? Let's go to the question. He has been trading for many years on 1st January. So what is that? Obviously the opening inventory. His opening inventory is 30 washing machines which cost $9,500. Okay. So 30 opening inventory is 30 washing machines which costed $9,500. So this is our opening inventory. No doubt about that also. Let's go. We even wrote the quantity and the amount. So this is the total cost. He purchased 65 machines in the year amounting to $1,50,000. So these are the purchase. 65 purchase are 65 and it is $1,50,000. What else is given in the question? Let's quickly see. He has, and on 31st December he has 25 washing machines left in the inventory with a cost of $7,500. What is that? Closing stock 25 and 7,500. Closing stock 25 and $7,500. What are the sales? Peter had sold 70 machines with a sales value of 215,000. 70 215,000. This is the value of the sales in the question. Clear? Calculate the gross profit for the year. So you have everything with you. All you need to find is the gross profit. So in this question, what will we do? We will ignore the quantity because they are only asking us about the gross profit. So we have all the final values given here. If this value was for 1 unit, then we would have multiplied with the number of units, but they have given us the total value, so we will not look at the unit or the numbers. Fine, let's start with this question. Let's first find the cost of sales. You know all the formulas, try to do it by yourself. I am also doing it for you. So you know what cost of sales is. Opening stock plus net purchases minus closing stock, which is 9,500 plus purchases minus of closing stock. How much is that? This is nothing but 9,500 plus 15,000 minus 7,500. So it is 15,200. See, 15,200. So this is our cost of sales. So we have the cost of sales with us. Okay, now let's move on. What do you have to do? We have revenue with us. We have revenue or sales with us. So revenue minus cost of sales is GP, right? GP is revenue minus cost of sales. What is the revenue? 215,000. 215,000 minus cost of sales, which is 15,200, will be nothing but 215,000, 63,000. Okay, so our answer is 63,000. I hope you're getting the same answer. Let me know if you're not getting the answer, and you can watch this again so that you can solve it again just the way I did, so you'll get the correct answer. So our GP is 63,000. I hope you understood how we got it, and I hope you understand why I ignored the number of units, because the total amount is already given. If the question would have said that 1 unit is 900 rupees or dollars and you need to find for 30, then it would have been a different story, but here we've been given the exact thing. Okay, see, I told you it's easy. Let's go forward. Okay, so these are some 2 journal entries which you need to keep in mind, because this is important, but don't get too deep into it. It is very easy. You don't have to get confused. At the end of the year, 2 basic adjustments are required to recognize opening and closing inventory. So don't get into the detail of it, but just try to remember this. Opening inventory. So these are some of the journal entries. Just keep in your mind that opening inventory is always an expense, okay? And closing inventory is always an income to us. Don't get into the details of why, but just keep in mind that our opening inventory is an expense and our closing inventory is an income. I'm asking you not to get into the detail of it right now, because in the further chapters you will be studying this in detail. So right now it won't be tested in your exam, only the journal entry will be tested. So let's just go with the flow and we'll do it as and when it's required. So opening inventory is always an expense and closing inventory is always an income. Okay, and you know that all expenses are debited and all incomes are credited. Now let's see the journal entries. Opening inventory and closing inventory. So first of all, you need to keep this in your mind. Okay, I know you're not able to understand it right now, but let me tell you. So we are debiting the opening inventory. Why? Because opening inventory is an expense, which means you will obviously debit the open inventory with the cost of sales. So in bracket you have to write cost of sales, and you're crediting the inventory assets. And in closing inventory it is our income. Now try to tell me the answer by yourself. It's gonna be just credit closing inventory in cost of sales. Debit inventory assets. So these are some journal entries you need to keep in mind. Just keep in mind that the other account is called as inventory assets, and your opening inventory or the closing inventory is nothing but bracket of cost of sales, and opening inventory is an expense, so you debit it. Closing inventory is an income, so you credit it. Just keep this in mind. It's not difficult. Just keep this journal entry in mind. Okay, so moving on to the illustrations. So these are the ledger accounts. So these ledger accounts will not be tested in your exam at all, because they are not that important. The ledger accounts which are given here in the illustration are not important, but I'll still just discuss these ledger accounts for you guys. But just keep in mind that it won't be tested. Okay, so let's read the illustration. In TYO1, Peter has opening inventory of $9,500 at the beginning of the year ended 31st December 2007. Peter's opening inventory ledger account would be presented as follows. So this is the inventory ledger account. So you know that inventory's balance is always on the debit side. So we have the balance given here. As inventory is an asset, this is currently shown as a debit balance. This I've just explained. At the end of the year, the opening inventory must be removed from the asset and the expense recognized as follows. So what is it? Debit cost of sales 9,500, credit inventory assets. This is the same journal entry which we have just learned, right? So what do you do with the opening inventory? You debit opening inventory in cost of sales and you credit the inventory assets. This is the same thing which we have discussed. Just go to the notes again and check it again. To provide a simple illustration of the effect of this adjustment, a cost of sales T account, what is the T account? It is our ledger account, has been set up. This already includes 150,000 of purchases made by Peter during the year. Okay. So this is our inventory, this is our cost of sales, this comes from the journal entry, this is the balance. So the cost of sales will again come here. This is the cost of sales account, and we have been given the purchases, and purchases will come here. This is the basic journal entry which we have done in the previous chapter, so I don't think there's anything to explain. Next, the closing inventory for the year 7500 must be recognized using the following adjustment. So you know how to recognize the closing inventory. Even this we have done, and in the same way we have made the ledger account for opening inventory. You make for the closing inventory and the cost of sales account again. Now we just have the ledger accounts can be closed off for the year, and we have done the balancing over here. And whenever it comes to the cost of sales account, you take the balance to the P&L. So that's it. These are basic journal accounts. You can do it by yourself. It won't be tested in the exam. Let's do the test your understanding too. The trading position of a simple cash based business for its week of trading was as follows. So these are given with us, and we need to make the T-shaped accounts of the same. Again, this won't be tested in this chapter, so we will do it in the end. We will do it for sure. We will do the test your understanding too towards the end of the chapter, but let's first move on to the next topic, and we'll come back to this for sure. And the same thing with this also, we will come back with this because these are the least important parts of the chapter. Now we come to the next topic, which is valuation of inventory. So what is inventory? We already discussed what inventory exactly is. Now let's see what the inventory actually consists of. So the inventory consists of goods which are purchased for resale. If I am having a business, I will purchase the goods for the resale. So the goods which I am purchasing for the purpose of resale is included in the inventory. Consumable stores. So what are consumable stores? Things which I can consume, like oil, etc., are the consumable stores. Raw materials and components, the things which are used in the production process of the products in my business, are also included in the inventory. Partly finished goods, so goods which are in progress, which I have not completed yet, which are half done, which are work in progress, they are also included. And the final one is the finished goods, which is the final goods. So these are the items which are included in the inventory. Now let's come to the inventory. So I had discussed in the starting of the chapter that in this entire chapter we will be focusing on IAS 2. So keep that in mind. Now, so there's one thing you need to understand. First, there is a cost. What does cost mean? Cost is the amount which has been used to actually make the product. The actual cost of the product, or the actual amount of money I have used to make a particular product, the cost price, the manufacturing price, that is known as the cost. What is a net realizable value? Net realizable value is the value for which I have sold my goods, or the value of the goods now. So the initial first price of the good, which is the cost price, comes under cost, and the net realizable value comes under the sale price or the future price. The actual price is always the cost. So you know that cost is always the actual price. The actual price. Okay. So now let's read what's written under the cost. All the expenditure incurred in bringing the product or service to its present location and condition. This includes cost of purchase, material costs, import duties, freight, and cost of conversion. This includes direct costs and production overheads. Okay, so cost. So whatever expenditure we have incurred in bringing a product or service, which is to manufacture a particular product, that comes under the cost. So this is what we have discussed. So keep this stuff in your mind, that the cost of purchasing of the raw materials and the cost of freight, which is carriage and everything, is also included in the cost. Now let's see what net realizable value really stands for. So what is net realizable value? Revenue expected to be earned. Did you understand? When we were talking about cost, we were talking about expenditure, but when we are talking about net realizable value, we are talking about revenue. So that's the difference. Revenue expected to be earned in the future when the goods are sold, less any selling costs. So, what do you understand by selling costs? So, if I have to sell something but there is a selling cost on it, for example, if I have to sell this good right now, I need to also pay for its traveling. Let's say if I am giving, if I am selling a washing machine for $50, and but I have told the customer that if you buy my washing machine, I will transport it to your house for free for, let's say, $5. The transportation charge is actually $5, but I told them that if you buy a $50 worth washing machine, which is not realistic, but still, then I will give you free shipping. So, what is my income? This is the free shipping. So, they are giving me $50, but I have to give them traveling. If I have to give them traveling, what is my net realized value? $5 go out from my pocket. So, 50 minus 5 is 45. So, my net realized value is 45. So, what is this 5? 5 is the selling cost. So, selling cost is anything which we have to incur after selling of the goods. I hope that's clear and you have no doubt in this. Let's move on. Okay, so this is just what we have discussed, but let's look at it again. Cost includes all costs of purchase, costs of conversion, and other costs incurred in bringing the inventories to their current location and condition. Cost of purchase. Okay, the thing I've written in the pen, with the pen, the carriage inwards and the carriage outwards, make sure that you will write them down as well, because this has been missed in the textbook, and even if it's not missed, this is something you need to know. So, cost of purchase includes material cost, import duties, freight, and carriage inwards. Cost of conversion includes direct costs and production overheads. Depreciation of productive machinery is included here. So, this and carriage outwards. So, we've discussed all this. And depreciation, what is depreciation? We will see that in the next chapter. But depreciation also comes in the cost of conversion. According to IAS 2 inventories, the following costs should be excluded from the cost of inventories: selling costs, storage costs, cost of abnormal wastage, and administrative overheads. So, all of these costs have to be excluded from the inventories. However, that storage costs could be classified as a part of cost of inventory if they were incurred as a necessary part of production or the manufacturing process. An example of this could be a product stored while it matures or ripens before it's. So you got it? So these are some things which should not be included in the cost. What are they? Selling cost, storage cost, cost of abnormal wastage, etc. and administrative overheads. So these are one-time things, so these should not be included in the costs. Clear? Upon reaching an appropriate level of maturity or ripeness, the product would be processed to the next stage. So in such a situation where it is necessary, that can be included in cost. That's what cost is. We have discussed it twice now. I hope that is clear. Now let's go to the next thing, which is the net realizable value. So we know what net realizable value is. It is also referred to as the fair value less the costs to sell. So fair value, or whatever price you are selling it to, or what the value of the product is when you are selling it or when you are disposing it, that is the realized value or the new value or the net value. Now let's read about it. Net realizable value is the net amount that would be realized after incurring any further costs required to make the sale. Any further costs could be anything. For example of what I said, the transport example, the washing machine example, or whatever selling cost must be. For example, I have a good, let's say I have a, let's say I have a TV. I am selling a TV and I am selling the TV for $80. But the TV's, let's say one component of the TV is broken. The TV which I have, it's broken. So I can still sell the TV. I can still sell the TV, but for selling the TV for $80, I need to repair the TV. So I need to repair the TV for, let's say, $10. After repairing the TV, I can again sell it for 80. If I am going to repair it, what will be the net realized value? 10 is going out from my pocket. Even though they are giving me 80, this is going out from my pocket. So which means my net realized value will be $70. So I hope you understood this. I hope you understood what the further costs required really means. So this may include, for example, further work and costs required in order to make the items of work in progress into finished goods before they could be sold. If IAS 2 is applied, when items of inventory are old or obsolete, they are likely to be valued at net realizable value rather than cost. So one thing you need to keep in account, you remember the accrual concept, you remember the matching concept, you remember all the concepts, right? And you remember, okay, I will not tell you the name of the concept. I want you to write in the comments below. Which concept says that you need to value the price or the amount of a good, the lowest of it? Which principle says that, okay, I'll give you a hint. It starts with C, which is one business principle which states that you need to value the things, you need to always value the losses, but you should never value the profits. In your books, you should always expect losses, but you should not expect profits. Okay, I'll just tell you the answer. It is conservatism. So what do you mean? If I know that my book can be sold for either $10 or $12, both of them can happen. I think my book will be sold for either $10 or $12. So in my books, what should I mention? 12? No, I should always mention $10. Whatever is lower, I should always mention that, because overvaluing profits is not a good thing. Undervaluing profits is also not good, but it is still better than overvaluing the profits. So whenever you have the cost, let's say the cost is 5 and the net realizable value is 2, which one will you write in the book? Always the lower one. Always the lower one. Lower one is always to be written in the book. I hope you write this down somewhere. If my cost is 1 but my net realizable value is 7, which should I write in the book? The cost. So whichever is lower, that should be written in your book. So that is what is mentioned here, the lower of. So if the cost is lower, you are going to write that in the book. If the NRV, which is the net realizable value, whichever is lower, that should be written in the book. I hope the topic is clear till here. Okay, moving on. IAS 2 disclosure requirements. According to IAS 1, presentation of financial statements entities are required to disclose the accounting policies adopted in preparing their financial statements, including those used to account for inventories. IAS 2 also requires that the total carrying amount of inventories are broken down into appropriate subheadings or classifications, and that the total amount of inventory carried at net realizable value is disclosed. So this is something which you need to read. We have discussed. Inventories are valued at the lower of cost and NRV for each separate product. So this I have told you, whichever is lower, that you need to take into account. Cost is determined by recognizing all costs required to get inventory to its location and condition at the reporting date, and applied on a first in and first out basis. So what is the first in and first out basis? This is something which we will be studying in the further chapter. FIFO method, first in first out, is also known as the FIFO method. So this is something which we will be looking forward. Net realizable value is the expected selling price of the inventory less any further costs expected to be incurred to achieve the sale. This is something we have discussed. Right. Now, here, look at the question. You have raw materials, work in progress, and finished goods. Okay, this page has come by mistake over here. Give me a second. Yeah, ignore this right now. I've missed a page. Okay, so now let's see the Giordano example. So, what is this Giordano example? Let's talk about that. Giordano is a small furniture manufacturing entity. All of its timber is imported from Scandinavia, and there are only three basic products: bookcases, dining tables, and cupboards. The entity has 200 completed bookcase in inventory at the end of the year. For final account purposes, these will be stated at a lower of cost and net realizable value. How is cost arrived as? So you know that we have done the theory. This will not be tested in your exam in this format. You don't have to write these long answers. It will be in MCQ. You know that cost of purchase will be included. You know cost of conversion will also be included. And you know what all come under this. So this we have read. So you can do it. And you know what fair value less than cost to sell also is. Now let's go to the test your understanding for. So what is the test your understanding for? Let's talk about that. Cole's business sells three products X, Y, and Z. The following information was available at the end. So what is the value of the closing inventory? So first and foremost thing which I have said, you need to circle which one is lower. Is the cost lower or the net realizable value? Which one is lower? Let's talk about that. Cost. Okay, this is the X good, this is the Y good, and this is the Z good. Let's see X. Which is lower? Cost is 7, fair value is 10. Which is lower? 7 is lower. So circle that. Let's talk about Y. Cost is 10, fair value is 8. Which is lower? 8 is lower, which means fair value is lower. Let's talk about Z. Cost is 19 and fair value is 50. Which one is lower? Again, it is the fair value. Now you know how to find the total, which is cost, which is the cost or whatever the amount multiplied by the number of units. Simple. So multiply 7 into 100, 700, 8 into 200, 1600, 15 into 300, and you have to add it all. Right? 450. Let me just add it all. Oops, this is 4500. Okay, so it is 1600 plus 700, which is B. The option is B, which is 6800. Tell me if you got the answer. I'm giving you a minute. So what did we do? Let's just quickly revise. We are checking cost and fair value, whichever is lower. We are considering that. We are considering the price as which one is lower, that, and then you multiply it by unit, and you got all the three inventories 700, 1600, and 4500, and then you add the three and you got 6800. That's it. Very easy. Okay. In what circumstances might the fair value less for the cost to sell of inventory be lower than its cost? Okay, so let's discuss the answer for this. Think about it. What is the situation when such a case might occur? So, what really happens is fair value less for the cost to sell may be relevant, but it happens in like special cases. This we have also studied, right? When there are goods which are damaged or goods which are obsolete. So in such a situation, this happens. Let's go to the test your understanding 6. So what is the test your understanding 6? Storm and entity had 500 units, a product of a product X. The product had been purchased at a cost of 18 per unit and normally sells for 24 per unit. Recently, product X started to deteriorate but can still be sold for 24 per unit, provided that some rectification work is undertaken at a cost of 3. So, What did we discuss? When we are repairing something, we have to take it out of our pocket, right? So the initial cost was 18. The cost has been given and the cost says that it is 18, and it could be sold at 24, but provided the 3 repair has to be done. So what is my cost? Oops, just a second. Yeah, what is my cost? My cost is $18 per unit. My net realizable value is $24 minus the repair dollars, which is rupees 3, which gives me $21. Now tell me, which one is lower, cost or NRV? Cost is lower, so we will go with cost. Which one is lower, cost or NRV? We will go with cost. Now you have to multiply it with the number of units, which is 500. So what is 18 into 500? 18 into 500 is 9,000. So our answer is 9,000. I hope you're writing it down and you have no doubts in this of how we got this. Moving on to the next test to understanding. Hurricane, an entity, had 1500 units of product Y at 30 June 2008. The product had been purchased at a cost of $30 per unit and normally sells for $40 per unit. Recently, product Y started to deteriorate and can be sold only for $38 per unit, provided that some rectification work is to be done. Okay, let us talk about it. The cost is 30. What's the final price? They said that it can be sold for 38. Because this sentence is given, now we will ignore the 40. They are saying that it can be sold for 38, but this much has to be done, which is nothing but 38 minus 10 again. So let's write it down. The cost which is given is nothing but 30 and our net realizable value is 38 minus 10, which is 28. Which one is lower, cost or NRV? NRV is lower. So our answer is, we have 1500 units. So we have 1500 multiplied by 28. 1500 multiplied by 28, which is 42,000. 42,000. I hope you understood how we got it again. And I hope you're writing it down, because if you're not writing it down, I'm pretty sure you're not able to understand anything I'm writing, because you can't understand like that. Okay, let's go to the test to understanding 8. This is very easy and this is something which is straight from the definition. The answer is C. I've given you the answer and I think you can figure it out by yourself. Okay. Now we come to the methods of calculating the cost of inventory. So there are 3 methods by which you can calculate the cost of inventory. Now this is where the questions will come. So this I will be doing in the next video. There will be another part for this chapter. So make sure that you have revised everything that we'll be doing in this, done in this video, so that you'll be able to understand the next video. So here we'll be learning about all the ways in which we can calculate the cost of the inventory, and we'll do all the solutions for the test understanding, and we'll finish the chapter in the next video. It's not difficult, but it's just, you just need to practice. So we are done with this, we are done with this, we are just left with this. Okay, so we'll be doing this in the next. In the following videos, we will also be solving the Kaplan exam kit, so make sure that you check them out also. I'll link everything in the description box below. And we'll also be doing these test your understandings which we have left in the middle in the next video. Thank you.